Good morning, everyone. Emily with Engel and Volker Spokane here, and for my co-host, I have Riley Anderson, who today is going to be talking about interest rates and where things are going.
All right, so today we're going to talk about purchasing power, interest rates, and where the market's been and where we're kind of going. So obviously we're all kind of feeling the squeeze over the last few months. There's been lots of talk in the news and the federal government between inflation, rates, interest rates, but the prime rate and all the other things that go into effect that the mortgage brokers and the banks take into account when it comes to lending you and I money for a house. In 2020, 2021, we were super fortunate. We could borrow a lot of money for relatively cheap. A 2.5, 2.75, 3.0. We were seeing rates like that really no one has ever seen before. We've had historically the greatest rates that we've ever seen in the last 100 years. Back in the 80s and 90s, there's times that people saw 12, 14, 18% mortgage rates. So to see this low of a rate, even though we're purchasing really expensive homes, a lot more expensive than different generations have purchased, we're borrowing money for really, really inexpensive, so really cheap money. But things are kind of starting to change a little bit, and everyone's quite worried, and we're hearing it a lot here in the office, worried about where the interest rates are going and what that's going to do to the housing market. So let's kind of dissect that a little bit. Let's just say for today, our current interest rate is, let's just say 3.5%, and you have a 720 credit score, you have 0 debt, and you want to buy a $450,000 house. So this is what the banks would consider a well-qualified buyer. No other debt, no student loans, no car debt. Like, this is as good as it gets, right? At a 3.5% interest rate for a $450,000 house, and you're able to put the magical 20% down, which is going to be $90,000. You're going to end up with a total mortgage of $360,000 and a monthly payment of $1,617. That doesn't include taxes, insurance, PMI, anything. Well, you're not going to have PMI if you do 20% down, but it's not going to include anything other than your principal and your interest payment to the bank. So let's now bump this mortgage rate, same exact thing here, up to 4%. Let's go up a half point. So same buyer, 720 plus credit score, 0 debt, $450,000 house, 90K down, $360,000 mortgage, and the monthly payment is going to be $1,719. So about a difference of $100 a month. Okay, so you're talking $100 over a year, $1,200. Not that big of a deal. So a 0.5% when it comes to your mortgage payment in the scope of the whole loan, $1,200 isn't a whole lot each year. Now, $100 a month might really negatively affect your cash flow. It might affect your monthly budget. Everything else is super expensive. So your grocery budget, your going out budget, anything else like that. So we say $100 doesn't feel like a big deal, but in all reality, when you're talking to a good bulk of buyers in Spokane and a good bulk of us that are median wage earners, that's a big deal. So if you have that house for 1 to 5 years, yeah, are you going to be able to afford that? Yeah, it's probably going to work out just fine. And then when you go down the road to sell that house, you're going to recuperate a lot of that cost from the value of the home likely going up like they tend to do, and any other improvements that you've made. Now, let's talk about this same exact scenario here, but you hold the house for 30 years. So if you're holding this house for 30 years at 3.5%, you're going to pay a total mortgage payment of, if no extra payments, no extra money, just straight, you pay the same payment for 30 years straight, you're going to pay $582,216 total dollars. If you're paying it at 4%, you're going to pay $618,926. So a difference of about $36,000 between the two. So this 0.5% increase in your rate over 30 years cost you $36,000. which sounds like a lot of money. And it is, but at the same time, $36,000 over the whole life of the loan isn't necessarily going to completely be a life-changing amount. So this is where it becomes really important that you sit down with a well-qualified mortgage broker, you talk to a real estate advisor, and you make a plan. If you don't know your numbers ahead of time, you can't properly go look at homes. It's really fun to window shop. It's really fun to look at expensive homes and good deals on houses, but you really need to have a solid plan in place before you start really looking for a house. Now, the other thing I want to bring up here with interest rates and mortgages is what purchasing power we might have. So purchasing power is basically the budget gurus of the world have come up with. There's a certain percent of the maximum allowable amount of money that you can spend a month on housing. So I think a lot of people use the 21% figure. We're just going to go off of what the typical is here. So purchasing power, let's just say you're a median wage earner in Spokane County. So you're going to be making about $75,000 a year. That might be a little bit high, a little bit low. It kind of depends on who you are, who you're talking to, your family situation. But let's just stick with 75 grand a year. You have, again, zero debt. This means you've been working hard at this. You've paid off all your student loans, you've paid off your cars, you've been able to stash away money. This is a long process here, right? So let's say you're making 75 grand a year and no debt. You've saved, you've been really good, you've been working super hard. Maybe you had a family member gift you some funds. There's lots of other scenarios. Maybe you got a bonus at work and you've saved $90,000 for a down payment, which is a ton of money, especially for a down payment, especially as a first-time home buyer. If that $90,000 is a 20% down payment, you're able to buy, with this scenario, a $450,000 house at 3.5%. So here's where it gets tricky. What if this 3.5% interest rate goes to 4%? How much of a house can I afford under these same exact terms? And that's going to be $438,000. So suddenly, this 0.5% increase here, or this increase, is made your total purchasing power go down. Let's say it goes up another percentage, or another 0.5 point, all the way up to 4.5%. This purchasing power now is only $422,000. Again, this is with the same down payment at $90,000. So this ends up, as rates increase, it doesn't just change your scenario here for your monthly payment and your total interest paid, total mortgage paid, but it also changes how much you can actually borrow from the bank if you're still making the same amount of money. And I know, for me, rates are going to go up quicker, or rates are going to be able to change faster than my annual income is going to change. So there's a ton of turmoil in the market when it comes to interest rates, and I know everyone's kind of feeling the squeeze right now between, like I said, household goods being more expensive and our monthly budget's changing a lot. But I think the most important thing here is that before you start looking for a house, or before the year kind of starts to escape you, you need to sit down with a real estate advisor, and then you need to sit down with a mortgage broker or your bank or a credit union or whoever you plan to borrow your money from, and have these discussions and look at different scenarios. Do I put down 5%, 20%, 30%? Do I buy my rate down a little bit? And that's where having that well-qualified mortgage broker or bank that you can talk to and have those conversations, because that's not our area of expertise. We need to understand this and help our clients understand this, but you're going to need to speak with the bank to really nail down these figures. And then once you have that pre-approval letter, we can go start looking at houses. So that was our topic for this week. We're going to be doing these as often as we can. We'll keep coming out with good information for you guys, and so keep checking back. And like I said, the most important thing is sit down with a qualified advisor. Give us a call, just a simple phone call. And there's no pressure here. We don't have to force you into anything. We just want to help along the process.